Hello everyone, welcome to this channel. My name is Ruben and today I want to give you an update on StoneCo. I will do a deep dive in this company. StoneCo is interesting since Berkshire Hathaway from Warren Buffett and Financial from Jack Ma both invested into the Brazilian e-commerce group when the company did an IPO in October 2018. But lately ARKInvest from Cathie Wood has been loading the truck on this stock as well, and as of now the stock currently trades between 40 and 41 US dollars with a market capitalization of $12.5 billion. But first, what is this company about?
Tell everybody a little bit about Stone, what the company is, how it got started, and why it's had such explosive growth over the last 6 to 7 years.
Well, the market was closed in the financial industry in Brazil. Just two credit card acquirers. 20 years overcharging and underserving merchants. So basically, with the experience of having built other companies in Brazil in fintech, we saw in 2012 the opportunity of starting something with a much better product, developed from the scratch. So we needed to seriously put something together that would be 10 times better than our competitors. As we always say, we have to be much better in terms of products, and we created a customer service that would amaze customers, which in the financial industry is something that people were not used to think about. And we created a distribution channel that goes directly to these merchants across Brazil in all small cities of the country, and we talk directly to them and we understand their needs.
Now you look at the explosive growth that Stone has had. What do you think the business is going to look like in the next 5 to 10 years? Where might it grow in other areas?
Well, payments is just the beginning. So we started with payments because it was the main pain point of those merchants in the beginning when we started in 2012. But we started putting a lot of other products and presenting products to our client base, and most of them have been successful and adopted by our client base. So we try to provide what they want. So we're building the company from the client's point of view to Stone's point of view. So we try to understand what they want, and many things that they want have to do with the financial industry. So they need an account. They don't need a bank. They need an account to make wire transfers, to pay their bills, and they need a credit to run their businesses, to help them grow to the next phase. So we provide them what they call the ABC, so the platform that is acquiring, banking, and credit. And we also provide them credits. We provide them a software, as we call the Act 2, which is giving them softwares to help them become more productive and grow their businesses.
Why don't you think any of the incumbents did this? What was the opportunity for Stone to step in and solve that problem?
Yes, I think we had to have that entrepreneurial and a technology background to think like that. And I think they had a lot to lose. So we could be cheaper, much more efficient with a technology created from the scratch. We could provide many other features that for them would be very difficult to create. And we think about software all the time. So we think about new features, and the software needs to be very adaptable to bring new functionalities to the customers. And we need to have the mindset of putting client first, which is something cultural. Difficult for these incumbent banks to think like that.
StoneCo in a nutshell. StoneCo offers financial technology solutions for Brazilian businesses, including point-of-sales devices, digital bank accounts, credit card processing, payment processing, and other digital features. And on this platform, you have digital capabilities such as acceptance and capturing. Think about checkout, QR code, and terminals. The second step is processing and fraud handling, so processing your payment and dealing with fraud if that occurs. The third step is settlements, payout, and capital. Here you can think about receivables and prepayment, and for the banking and capital part, it's about card issuance, P2P transfer, and balance account. And the last step is management and extensions. So you as an entrepreneur, you want to have insight into your data. So this comes down to analytics using a fancy dashboard as well. And talking about StoneCo, you can also think about the earlier days of Square as an enabler of the SMB payments processing, because StoneCo is pivoting towards becoming a one-stop shop digital platform for Brazilian businesses, as evidenced by the recent closure of the Linx acquisition. And I will talk more about that later. And management is also continuing to push into becoming the leading fintech as a service provider with their Pagar.me platform. Well, Pagar.me, that's the payment service provider, also known as the PSP, that helps small business owners to accept online cards quickly, providing an all-in-one experience to the customer. The opportunity for e-commerce is immense because Brazil is the largest country in Latin America and has the 5th largest population in the world. But cash is still the preferred method of payment by 71% of Brazilians. More than 150 million Brazilians are internet users and 67% have access to smartphones. Brazil has a population of 211 million, and according to a study from JP Morgan, online sales only accounted for 3.2% of the total retail spend. So there is a significant opportunity for StoneCo to penetrate this market with its financial and software solutions. The COVID-19 pandemic seemingly turned everything digital. Social isolation measures and the spread of remote work took existing trends and set them on a hyperdrive, and e-commerce saw huge increases in sales, essentially replacing all in-person interactions. Well, June 2021 marked a significant milestone in StoneCo's ambition to become a leading digital infrastructure provider for Brazil's businesses, as the long-awaited acquisition of Linx, which is a provider of enterprise software with a large footprint across Brazil, was completed. The acquisition will combine StoneCo's expertise in serving small and medium businesses with their online payment capabilities and Linx's strong footprint and full suite of digital enabling commerce solutions, including retail point of sales presence. And the business combination will not only create a powerful digital and physical commerce enabling platform, but it will also provide StoneCo with meaningful cross-selling opportunities into the more than 70k plus medium and large businesses. This move should accelerate StoneCo's strategic roadmap to become a one-stop shop for commerce in Brazil, which is estimated to be represent an annual opportunity of 300 billion Brazilian real of gross merchandise value to be penetrated with payments. And this makes StoneCo much more than just a payment processor and loan originator, but extends its offerings into the fast-growing commerce segment as well. During the last conference call, they also talked about the current priorities and the current focus for the Linx acquisition. 5 points. The first one is migrate financial services to the Stone platform and further penetrate their existing products with offerings to the Linx clients. They want to invest in technology capabilities to enhance the existing platform, connecting the Linx unique retail's workflow integration with superior user experience and client satisfaction. On top of that, StoneCo wants to build infrastructure and tools to enable any merchants to have that multi-channel storefront, and they also want to create a merchant data management architecture that enables StoneCo to create new financial products. And by creating new financial products, they will add more revenue, and that will also increase net income. And of course, if you integrate two businesses, you want to seek synergy to become more cost efficient. Well, last May 2021, StoneCo entered into an investment agreement with Banco Inter, where StoneCo will invest 2.5 billion Brazilian real into this company and hold a minority stake of 4.99%. Approximately, this comes down to $471 million. Banco Inter is a leading digital bank in Brazil, acting as a service platform aiming to simplify people's lives. At least that's on their website. And Banco Inter has a large user base of approximately 10.2 million. And they have several product offerings such as banking, marketplace, credit, insurance, and investments. And on the left on this sheet, they define several value creation drivers. The first one is connecting the Stone merchants to the Intershop, driving the digitization of Stone merchant base and providing an omni-channel journey for Intershop consumers. They want to enable a seamless mobile payment experience between the interconsumers and Stone merchants, online and offline. Besides that, they want to enhance the value proposition to the Stone and Inter client base by leveraging product and payment technology capabilities for both of these companies. And lastly, leverage Inter's funding capabilities to drive the further efficiency in Stone's WK offerings and giving Inter clients access to the new investment opportunities in fixed income through the offering of FIDCs. While StoneCo is growing very rapidly, we look at the top line growth quarterly data. As seen in the graph, growth in the number of payment clients and total payment volume had been growing at a rapid pace until the COVID crisis. However, there are signs of recovery with revenue and income surpassing the year-ago quarter. The company reported strong historical customer growth metrics as evidenced by the fact that the number of active payment customers increased 45.4% since the last second quarter of 2020. And then we have the exceptional growth of TON, which they reported separately. It grew more than 9.4 times compared to Q2 2020. And your question might be, what is TON? Well, StoneCo and Mass Media Grupo Global, they launched TON in the past. It's a new company focusing on servicing micro merchants and autonomous workers. It's basically a joint venture which was initially announced last July 2019, and it was waiting regulatory approval to begin operations, and it substitutes Stone Mais, a Stone division previously created to serve the same target group in Brazil. Then we have total payment volume that's up plus 58.6% year over year. And then we have total revenue and income, and that is down minus 8.1% compared to Q2 2020, and it has to do with non-performing loans, but I will talk later about that. There has been continued penetration of financial institutions. On the top left, they recorded a net addition of active clients in Stone SMB banking, and it's up plus 43% from the first quarter of 2021 to the second quarter of 2021. Acquiring clients settling directly in their Stone SMB account. On the top right, it's up plus 45%, also compared to the first quarter of 2021 to the second quarter of 2021. And on the bottom left, we have nearly half of Stone SMB are active in multiple financial solutions. So in other words, StoneCo is also deepening relationships with existing customers, as a share of StoneCo's customers are using more than one product. It increased from 10% in the fourth quarter of 2019 to 48% in the second quarter of 2021. So this is very good news for the company. Operating leverage and profitability, quarterly data. The total costs and expenses are going up. The same applies for financial expenses. Higher costs are due to investment into the company itself. StoneCo, they are building capabilities for the long term, and therefore they will continue to expand in enhancing their core SMB operation, opening new hubs and improving execution. So StoneCo will make significant investments behind their financial platform, which is a huge opportunity, and they keep working hard to provide more financial solutions and workflow tools for their clients. And if we look at adjusted net income and margin, that is down minus 24.5%. And it has to do with the non-performing loans.
What's it like right now to be doing business in Brazil and more broadly in South America?
Oh, Brazil is not easy. Brazil has a business environment which is not easy to start a business. Not easy to be an entrepreneur. But I think it's becoming better. It's becoming much better because now single-digit interest rates is something very structural to the economy of the country, and that by itself already helps a lot. But I think there's another thing that is going on, that the entrepreneurial spirit is coming to Brazil somehow. So you see, when I go to universities to talk to students, I see many other young kids, young people, that wish to become an entrepreneur, wish to start their own business, which is great. So it's a cultural move, a generational move that might encourage people to start their own business and win in life and create more pay more taxes and employ more people and create progress.
The Brazilian banking sector is a prime example of a small club of institutions that have dominated one of the most profitable industries in Latin America's largest economy, a sector characterized by costly banking fees, high borrowing rates, and subsequently high profit margins for the banking industry as a whole relative to other regions in the world. We can see that here. The Brazilian banking sector is highly profitable compared to peers. The green line is Brazil, the light blue line is the United States, then we have pink red is Europe, and the dark blue is Asia Pacific. And indeed, Brazil has higher rates in terms of return on equity above 15%, and Europe is really the lowest with around 5%. But if we zoom in on Brazil, the sector has mainly been controlled by 5 big financial institutions. You can think about Itaú, Bradesco, Santander Brazil, and a state-controlled Banco do Brasil, and the last one is Caixa Econômica Federal. However, the rise of neobanks and fintechs has been an unstoppable trend supported by favorable government-led initiatives. Much of the population in Latin America is underserved by banks. We make a comparison between 3 countries, Brazil, Mexico, and Colombia. If you focus on Brazil, they have the largest number of banks with 174. Compare that to Colombia with only 25 types of banks. For concentration, in Brazil it's really concentrated, so the top 5 banks own 80% of the market share. For Mexico, that's 69%, and for Colombia, it's 77%, so comparable to Brazil. And if you look at the unbanked population, in Brazil, it's 33%. Mexico is higher, with 50% of people that don't have a bank account, and Colombia, it's 32%. Let's have a look at the number of neobank customers from 2012 to 2021. In fact, Latin America had one of the fastest growing digital banking sectors globally over the past few years, with Brazil leading the growth by a wide margin, as evidenced by the number of neobanks that have emerged since 2012. You can see it here. In 2016, the number of neobank customers in Brazil was only 1.3 million, and compare that to 2021, it's already up to 63.5 million. And Mexico has been growing a little bit as well, but still Brazil is leading the way here, definitely. Growth of digital banks in South America from 2012 to 2021. It is currently growing with a compound annual growth rate of plus 27%. One of the biggest risks I see for StoneCo currently is competition. With respect to the emergence of neobanks and fintechs, Brazil is currently home to the birth of more than 20 digital banks per annum and counting more than 770 emerging fintech companies as of August 2020. And besides StoneCo, Warren Buffett's Berkshire Hathaway has also made some large investments within this Brazilian fintech and neobank space. And they made an investment of $500 million into a neobank called Nubank. Here's the top 6 market share for StoneCo. I won't pronounce the Spanish names probably correctly, but I will try anyway. StoneCo's competition currently includes Cielo, Rede, Getnet, all of which are controlled by or subsidiaries of local banks. And we have Pagseguro, that's also a disruptor, and some of the competition is substantial for StoneCo. For instance, Cielo made an agreement with WhatsApp, that's owned by Facebook, and WhatsApp had at the time 120 million users in Brazil when the agreement was made. And in the chart here, Cielo and Rede together make up 58.5% of the market share in the second quarter of 2021. So that's the light blue color with 31% and the orange color of 27.5%. And StoneCo has 11.3%, that's the green color, and overall market share for Cielo and Rede is going down over time, where competitors like StoneCo and other competitors are slowly gaining market share, but it is still quite a lot of smaller than Cielo and Rede. Rush Malhotra from the Institute of Trading and Portfolio Management will give his take on StoneCo.
I do think emerging market valuations are actually pretty attractive here. I really do think that, and I think there's value in them as a whole. Obviously, Brazil is hopefully going to emerge. I wouldn't even call it an emerging market yet, but it's got a long way to go. But again, Brazil is South America's largest economy by far, and it's been reeling from the effects of COVID. According to the Central Bank of Brazil, economic activity shrank 14% from a year ago in May. But however, so all that being aside, and this is part of the reason I bought it aggressively after the last earnings call, which they missed. Like the rest of the world, while business traction has shrunk dramatically, the digital space is picking up all the slack, and that clearly is in favor of fintech in Brazil and digital payment platform StoneCo, which is by far the leader. The company just said that it handled 51% of all of Brazil's e-commerce transaction in Q1 2020. So I would think that it would also be able to capture the rest of the Latin American market. It's the dominant force within the country on cashless payments front and the e-commerce. In e-commerce, if you look at the e-commerce as a whole, it's still just mid-single-digit percentage of the retail spending. So think about that, how much of a growth market that is. Again, it's only like mid-single digits. So there's such a big. If you believe that people will start shopping online more in Brazil, like they have in every other country in the world, why wouldn't this company just benefit off that? And again, like we've talked about before, the pandemic changes things permanently. Once you start buying stuff online, like in Brazil, people aren't going to go back. So, and the other thing too is, as much of the digital payments have been a boon to the company's also started credit services and merchants on their platform. So I mean that does have some potential risk if these merchants start to default on loans, but their tech is actually helped vet who needs help and checks the availability of the customers to make payments based on their transaction history, which Stone already has, which is actually a pretty cool feature. So they basically are able to predict defaults, and they just don't extend them credit. So that's another and positive this company. And that's actually something that most banks don't have. So that's actually another piece of the puzzle that they could actually outsource or sell to banks and other vendors. So again, the valuation is pretty premium territory. But I mean, given the opportunity and the pole position in Brazil, this could be one of the dominant players in South America. Right now, the stock's below 50. It could easily be $100 or higher in a year from now. And like I said, like we talked about in terms of bull markets within sectors, when there's bull markets within sectors, there's consolidation and M&A activity. Would I be surprised to see one of these companies try to buy this? So PayPal or Stone become the Brazilian to take this South American market? Absolutely not.
So what's the catch on this company? Short-term headwinds in credit led StoneCo to increase coverage for potential losses with a negative impact on revenues. Very simply explained, StoneCo had a higher percentage of non-performing loans, so companies were not paying back the loan, it took longer to pay it back, or were not paying back at all. That's currently the problem that this company faces. StoneCo developed a product with the assumption of a full functioning registry system, which was not working properly. Their previously assumption regarding the recovery of the non-performing contracts was higher than observed in the second quarter of 2021, influenced by how relevant the problem of collateral leakage is. On the bottom left, you can also see this. The decision to increase coverage for losses. You have the gross outstanding balance, so plus 60 days without principal payments is 35%. So 35% of the customers after 60 days has not yet made any principal payment, and 19% has not made any payment at all after 60 days. So they have several learnings from this. They used fair value methodology. Even though fair value methodology is an IFRS standard, they learned that it brings a level of volatility that creates management complexity, and StoneCo will switch from the fair value method to the accrual basis for the new portfolio, but the legacy portfolio will still be fair value based. And even though their credit solution was developed during a period with significant negative external factors, such as the lockdowns brought by the pandemic and the short-term problems with transition to the new regulatory framework, that's also another thing. They also had many learnings in this process, but for simplicity and clarity, I included the script from the Q&A conference call where management will discuss the non-performing loans issue.
Thanks for taking my question. On the credit product, this is going to sound similar to some of the earlier questions, but I wanted to ask on credit in a very specific way. My question is, can you walk us through the next 3 to 6 months from two areas? First, from a regulatory perspective, and second, from Stone's operational perspective, as you're thinking about those two areas right now. Because the question I have after reading the teaching paper and hearing the comments today is what exactly is going to happen over the next 3 to 6 months from a regulatory level. And then there's also, what should be happening concurrently by you, by Stone, as you move forward with the learnings you've had from this. I just want to put some markers down today for investors' sake so they have an approximate understanding of what to expect. So can you talk to us a little more about those two things? It would be much appreciated. Thank you.
Hi, Jeff. Yes, of course. Thank you for the question. Thiago here speaking. I think that from a regulatory perspective, the central bank is doing an incredible work of helping the markets to get to a solution. And the solution is not about the regulation itself. It's about the technical implementation by the players. It was a big change in the way that you see and use collaterals, in the way that you register the assets, and the technology that was made was not made in the right place. So I think that as we disclosed it in our teaching, there are many technical evolutions that the three registry of receivable has to implement, and that's what we'll be following in the next 3 to 6 months. It's about the technology of the registry of receivables and the interoperability between them to make sure that once we give credit to a client and we contractually receive the guarantees of all the transactions from one specific card brand, we can access that collateral in all of the payment players, regardless of the registry of receivables that they are using, without having collateral leakage. So the interoperability and the system has to evolve. I think we have talked a lot about this in the teaching to be easier to understand, and we will be following that implementation very closely. In terms of the Stone perspective and what we are doing, as Leah said, we are improving our underwriting risk assessment and capability to make sure that we really understand the client and the behavior of the client. Because two things happen here. One is the industry had this collateral leakage type of problem, but in the end of the day, our clients, they decided to move from our payment solution to another acquired payment solution. And then we were not seeing that cash flow anymore because of the collateral leakage. So what we want to evolve is why our clients move to another acquiring player. In the end of the day, we understand that because of the pandemic, many of the clients, they are trying to protect cash flows and renegotiate the contracts later, and we decided to move, not to pay the credit in the beginning. So we want to evolve our risk assessment of our clients to make sure that we protect the business for this type of behavior in the future. Although it's important that the collateral is working pretty well. The other thing is that we have to evolve in terms of our recovery process, our renegotiation with clients. Because if a client has a problem, we have to renegotiate with them to give them the ability to repay us back in the way that suits best for them and for our risk and return assessment. So we are evolving a lot in terms of the recovery process and the renegotiation with clients. The other thing is improving the credit scoring process in order for us to see other collaterals, more than the TPV and the card transactions that the clients have. Many clients, for example, they are the owner of the store, and we are not seeing the store, the actual store, the real estate as a collateral for the credit product, for example. So we're improving our ability to have more collaterals for the same clients. And in the end of the day, Jeff, as I just said, there are some profiles of clients that maybe we will not be the one increasing credit risk to create the product, but we can provide for them the same level of experience with a third-party partners providing the credit and having us as the originational partner with a fee in that relationship. So we are working on those fronts in terms of the turnaround that we are doing in our operation in order to get the product back on track. So It's a two-way execution here, following the evolution of the industry and rebuilding our product. But in the end of the day, what we have to keep in mind is the product has to be simple. Rates has to be simple, and the client has to reconcile easily. We have to be paid back aligned with the cash flows of our clients. And we have to provide a better deal for the better client. We have to work on a way to make our clients sell more by buying more products and evolving. That is the fundamental of the product. So that's what we are focused here in terms of our execution.
Our revenue from transaction activities grew 57.9%, driven largely by the strong TPV growth in SMBs. Revenue from subscription services and equipment rental also presented strong results, growing 90.1% when compared to last year, driven by both an increase in our software revenue and a significantly larger Stone SMB client base. Our financial income, which combines the revenue from prepayment and the credit products, was affected by the negative result of the credit product of minus 397.2 million reais as a result of the increase in provisions for expected losses in credit, and ended up decreasing 87.7% to 40 million reais in the quarter. Excluding revenues from the credit product, our financial income would have grown by 67% year over year, demonstrating the strength of our prepayment operation. Our cost of services were 302.4 million reais this quarter, 52.2% higher than previous year. This increase was mainly due to higher investments in our technology and customer support teams and higher investment in TAG, as well as higher costs related to depreciation of POSs. Administrative expenses were 121.8 million reais, 35.5% higher than last year, due to higher third-party services, mainly expenses with software services, higher depreciation and amortization expenses, especially due to amortization of fair value adjustment on intangibles related to acquisitions, and higher travel expenses. Compared with the previous quarter, administrative expenses were 3.6% higher. Selling expenses were 223.2 million reais in the quarter, an increase of 94.6% year over year, mostly as a result of higher marketing investments, mainly in TON, and investments in hiring of salespeople. Compared with the first quarter of 2021, selling expenses increased by 37.1% to the same reasons that I just mentioned. Financial expenses were 157.6 million reais, 151.8% higher than the previous year, mainly due to the higher outstanding volumes of prepayment and credit and higher cost of funds, mostly due to the higher and increasing base rate in Brazil. Other income net was positive by 777 million reais, mainly related to a mark-to-market gain of 841.2 million reais related to our investment in Inter. Excluding this effect, other income was negative 64.2 million reais, 60.2% higher year over year, mostly explained by share-based compensation expenses and issuance fees regarding the $500 million bond offering that was successfully concluded in June.
So what are StoneCo's opportunities? I wrote 11 things down for you. In one sentence, I would say short-term pain, long-term gain. While the short-term headwinds may continue to have an impact on StoneCo, the bigger picture here is that it shows strong historical profitable growth. As StoneCo is pivoting towards becoming a one-stop shop digital platform for Brazilian businesses. One integrated solution where StoneCo keeps adding new functionalities based on what the customer wants. StoneCo is disrupting traditional banks by offering high quality payment solutions as well as lending products for small and medium enterprises. It's a leading fintech company owned by Berkshire Hathaway from Warren Buffett and ARKInvest from Cathie Wood, and even during the IPO in October 2018, and Financial from Jack Ma took a position in StoneCo. StoneCo is aggressive on acquisitions. You can think about the acquisition from Linx that we talked about, the partnership with Banco Inter, and they also heavily invest into their own businesses to grow because the focus is on growth. Digital payments and fintech are also in this growth mode. This total addressable market is still massive. Cash is still preferred by the preferred method of payments in 71% of the cases in Brazil, and this is going to become cashless. You can think about United States and Europe. They are way ahead compared to South America. And we are going cashless as well. The opportunity for e-commerce is immense and also still behind the United States and Europe. And as Malhotra mentioned, I can also see a scenario where StoneCo just gets simply acquired by either like Square or a company like PayPal, because consolidation is likely in the future since the market is fragmented. Well, Square bought Afterpay for $29 billion. StoneCo has a market capitalization of approximately $12.5 billion, so why would that not be possible? And personally, I liked the CEO and executive team. I listened to the complete conference call of 80 minutes. It was very interesting and learning for me. Thiago and their whole team show commitment in solving the non-performing loan issue. During the call, they were very open about it. They have a long-term view and look what the customer wants. And lastly, there's integration of the multiple companies that they acquired. So what about StoneCo's risks? Well, first of all, there's country risk, because Brazil has a history of financial crisis and a bad economy could result in lower growth for the company and also higher levels of bad debt on its credit books. The competition that we talked about, so either traditional banks or new challenger banks, they could start offering payment services that match or exceed the quality of StoneCo's offering. COVID risk. Well, the small and medium enterprises that make up the bulk of StoneCo's customers is being severely affected right now by the COVID restrictions. That will indirectly affect its total payment volume that StoneCo processes and the quality of its credit book. And of course, the elephant in the room, the credit risk. On the short term, there is increased credit risk and the management really has to execute on the non-performing loan issue. I would like to thank everyone for watching this video. I really hope you enjoyed it and that you actually learned something, and see you on the next one.